Market ends higher, Nifty closes above 26,000 and Sensex ends at 85,000. Mid-cap index hits one-year high. Auto index slips in a good market while metals, media and FMCG stocks among the top gainers. SEBI issues a consultation paper on mutual fund rules that seeks to enhance transparency on expenses but also trims outgo to brokers. The tightening move spooks stocks of AMCs and other market participants. Copper nears its all-time high, aluminium scales to a 3-year high, and zinc trades close to its 10-month high as optimism over a US-China trade deal coupled with supply concerns give bulls reason for cheer. Indian metal stocks rally with Nifty metal at record high for 6th straight session. Hello and welcome. In today's special edition of Markets Forward, we put the spotlight on SEBI'S consultation paper on mutual fund rules, which aims to enhance expense transparency and trim outgoings to brokers. But before we talk about it in greater detail, let's understand what these changes are now. SEBI has proposed a sweeping overhaul of how mutual funds charge investors, aiming to make the system more transparent, fair, and performance-driven. The proposal, if implemented, could lower costs for investors but also squeeze profits for fund houses and brokers. To begin with, SEBI has proposed reducing the total expense ratio, or TER, charged by mutual funds. For open-ended schemes, the cut could be up to 15 basis points, and for close-ended schemes, as much as 25 basis points. In simple terms, that's the portion of your investment that goes towards the fund's management and operational costs. Currently, equity-oriented schemes can charge up to 1.25%, but under the new proposal, that will be capped at 1%. For debt and hybrid funds or schemes that are not equity-oriented, the ceiling will fall from 1% to 0.8%. SEBI has also proposed removing the additional 5 basis points charge that mutual funds were allowed to levy on their entire assets under management. That extra charge was introduced in 2018 as a transitional allowance, and now SEBI feels it's time to rationalize investor costs. SEBI has also proposed that fund houses venturing into non-mutual fund businesses such as portfolio management or advisory must do so through separate business units. This ensures that costs are not cross-subsidized and that investor money in mutual fund is used strictly for that purpose. In addition, statutory levies like STT, GST and stamp duty, they will remain outside the expense ratio. This means these taxes will be shown separately, allowing investors to see the real cost of fund management versus regulatory levies. Now to one of the most interesting proposals, performance-linked expenses. Under this framework, mutual funds may be allowed to charge a higher or lower TER depending on how the scheme performs. If the fund outperforms its benchmark, the AMC could earn a slightly higher fee, but if it underperforms, the expenses charged would reduce. The idea is to align the fund manager's incentives with investor outcomes so they earn more only when you, the investor, does well. A detailed framework for this will be developed after consultations with the industry. This also marks a shift from SEBI's 2023 approach, when the regulator had proposed including all such charges within the total expenses, an approach that was met with significant pushback from the industry. While these proposals are investor-friendly, they may tighten profitability for asset management companies. According to estimates by Jefferies, a 5 basis point reduction in equity-related charges could impact AMC profits by 8 to 10% if the new rules take effect from FY27. The cut in brokerage fees could also hurt institutional brokers who might see lower revenue from mutual fund transactions. However, for investors, this could be a positive development with fewer hidden costs, lower expenses, and more transparency in how their money is managed. Comments are invited from the industry, and the deadline is 17th of November. In fact, earlier today, we spoke with Ashish Somaiya of White Oak Capital AMC and Sandeep Bagla of Trust Mutual Fund to understand the implications of the proposals if it goes through. Somaiya calls this a positive move. Meanwhile, Bagla says the impact will not be big. Listen in.
I think obviously the key takeaway is that for let's say you and me as investors and our viewers at large, it's really positive on two counts. One is obviously because mutual funds do have transactions and turnover. I mean buy-sell trades, and obviously if you assume, of course, the cost incurred was not actually 12 basis points. On an average, it would be lower. But net, if they're saying that the cap is down from 12 to 2, A couple of clarifications. First, of course, it will reduce the cost of transaction, and to that extent, the alpha generated by funds, to that extent, should actually go up because the benefit will go to investors. Second thing is that if you think of brokerage or whatever is paid to brokers as 12 bips, it's not entirely paid to brokers because there are components like exchange fees and stamp duties and STT and so many things out there. So it's not like 12 becoming 2. It will be more like, say, if it, say as per the regulatory paper, if it was 10, it might become like 4, 5, 6 or something like that. It will settle at because everything doesn't go to the broker. What the broker bills, there are further components into it which go to exchange and stamp duty and all those kinds of things. But yes, that will benefit investors. The second thing to keep in mind is that when you look at the, statutory levies within the TER other than this. So like you rightly pointed out, GST on the management fee was outside the TER, but let's also understand that there are various other components of operating expenses that we pay. Depending on the size of the fund, we may be paying anywhere between 8 up to 14, 15 bips as operating expense. And that has, say, the registrar's fees, it has the custodian's fees, a lot of other operating expenses we incur. Everything has a GST component in it. So for a moment, if I say that the OPEX is 12 basis points, you must assume that it is more like 9.5 plus 2.5, something like that. Because that 2 to 2.5 basis point of statutory levies, which is there in all the OPEX, that was also going from TER. So that has to be actually moved out. Then obviously one needs to wait for, further straightening out or, clarification on this. But there are other components in the TER also where there is a GST, which was actually hidden inside the TER. So net, lot of rationalization. And
what about that 5%, Ashish? 5% on...
5 bips.
I think that 5 on exit load, which you could charge, right?
Yes.
But that basically, it was not there pre-2012, right? So you're basically going back to that regime. It was introduced, I think, in 2012.
It was brought in when exit loads were removed in 2012.
Yes.
In lieu of that, it was 20 basis points and it was reduced to 5 basis points in 2018. And now it has been abolished. So how big a hit is that, Ashish?
Yes, yes, that's what I'm saying, that net, I think the TERs will go down. There is no doubt about it, because while the regulator has said that we are trying to remove all these components from the TER, and to that, so if that becomes X TER, then we are trying to reduce the TER and remove these components and make them TER++. But
is it bad for business, Ashish? That's the simple question. Now that you can't charge this additional 5 basis points and all the other, statutory charges have to go out of TER, I mean, if you look at the rationale the regulator has put out, it seems very clear, very clear. So I want to know how much is the expense ratio, GST, stamp duty, etc. is all plus.
Yes,
and
I think that...
Yeah.
Sorry. So you're right that at least that 5 basis points plus a bit more. So that will be, it depends what the AMCs take a hit and how is it shared with the channel going forward. But for the investor, I think the TERs will come down even after making all these adjustments of removing from TER, adding plus, etc. Net TER will go down. So the industry has to, figure out how to absorb that.
This is, gentlemen, I don't know if you agree, Europe has this MiFID regulation, right, which was brought about a few years ago. This is like India's MiFID moment. If this goes through, Ashish, you would agree?
Yeah, to an extent, it is looking like moving in that direction, especially when you talk about the cost of transacting and, brokerages, etc. But I think, over a number of years, what has happened is, as asset management companies' scale and size has increased, people have invested heavily into research, right? And not just the large AMCs, even, players like us, say we are more like 10 billion in size, but even we have a very large research team. At the same time, I would say that brokers don't just do transactions. There is definitely a lot of value addition, but I think we have to, arrive at some kind of working equation.
Okay, Mr. Bagla is also with us. Now, Mr. Bagla, you tell us, I'm asking a very simple question. Does this impact profitability? Will profits and margins for asset managers come under stress? That's the big question that shareholders of listed AMCs need answers to.
So, SEBI has proposed that what we charge, the total expense ratio, be reduced by 15 to 20 basis points. And lion's share would probably be reduction in distributor fees also. And some of the expenses like GST, STT, CTT are now allowed to get charged. So the impact will not be as much as the top line suggests. And it depends on how much distributor fees are also compressed by the AMCs. So in the short run, yes, there would be an impact in terms of lower fees when this goes through. But over a small to medium period of time, I think it will adjust. And if, looking at the growth at which the mutual fund industry is growing, I think we will see it as a small blip in the longer term.
Ashish, comment on this point. I mean, it essentially boils down to just this, right? How much can you compensate by lowering the distribution fee and the commissions, and how much can the AMCs absorb? Right now, I know it's very early days. If this goes through, can 50% be absorbed, and the share is 50-50 between distributors and the product manufacturers? How will it play out? The hit.
So listen, I think that 5 basis points plus that 10 to 15 basis points depending on slab. So let's say that net the regulator has spoken about reducing about say 15 to 18 basis points, right? And then let's say we benefit 2-3 basis points because a lot of the stuff which we're absorbing goes outside the TER. So I think all told, if you really ask me, the industry has to contend with figuring out how to manage this. I think it will be 10-12 basis points, not more, which is what the knock will be. But 10-12 basis points is a significant number. And yes, within that, clearly, we have to arrive at an equation. Now, different players will have different equation with the channel partners, but it will have to be split. Because ultimately, if let us say on an average 60% is going to the channel partner and 40% is going to the AMC in terms of retention, then it's only fair that even the knock is split accordingly. So I think that will be the bare minimum. So ultimately, when you ask about AMCs, it will boil down to low single-digit basis points of impact.
Meanwhile, Prateek Gupta, CEO and co-head at Kotak Securities, believes small and mid-sized brokers will be impacted if SEBI norms are implemented. In fact, he went on to add regulators should let free market forces to prevail and that they should encourage competition. Listen into what he had to say.
Obviously, the impact would be quite negative for partly the mutual fund industry and also the distributors and brokers who service or who are very heavily dependent on the mutual fund industry. But I think it will be very, very negative for some of the smaller brokers and also for some of the smaller mutual funds in particular. And even the larger funds and distributors, they will be impacted to some extent. And I think you will start seeing resources being directed more away from mutual funds towards other categories like PMSs, AIFs, or foreign portfolio investors. It's a free market, and brokers charge whatever. Even when we service FIIs, we have different rates for different customers depending on how much servicing they're taking from us, etc. So the best thing in my view is encourage competition, let free market forces prevail.
Okay, with that, we'll slip into a short break for now, but do not go anywhere. We'll continue the discussion on the other side of this very short break. Stay tuned. Welcome back to the special edition of Markets Forward. We are discussing and analyzing SEBI'S consultation paper on changes in expenses charged by AMCs or mutual funds for investors. Let's go across to a discussion I had with Shweta Rajani of Anand Rathi Wealth and Akhil Chaturvedi of Motilal Oswal Asset Management. I started by asking them about the impact of proposed rise in base level charges and if this impact will be neutral for AMCs or it will largely favor investors. Listen in.
Firstly, I have to say, the overall circular, if I look at it from a client standpoint, it's very good. And, over the years, we've seen SEBI has been focusing towards investor protection, investors' benefit, bringing in transparency in mutual funds, having more disclosures. And this is one welcome step, towards that again. Specifically talking about the 5 bips exit load, earlier on, also, if you see this, till 2018, this used to be 20 bips of exit load oriented fees charged, which was brought down to 5 bips. And this was any which way is supposed to be transitionary in nature. This 5 bips actually goes back into the scheme. It doesn't go into the AMC profits any which way. So from an AMC profitability standpoint, I don't think it's going to have any implication. From a expense ratio standpoint to the investor, this is again a good thing because it will reduce the expense to that impact. Because earlier on, what would happen is if the base TER was, let's say, around 1.8, and then you had this additional 5 bips. Now, while there has been a reduction on the total base TER as well, this 5 bips is now included as a part of that TER. So it brings down the expense for the scheme for the investor. So for an investor, this is good because it will mean marginal improvement in the NAVs and the return that you would see. As far as an AMC is concerned, this used to anyways get passed on to the scheme, not to the AMC profitability, so should not have an implication there.
Oh, okay, all right. So it should not be that big an impact on the AMC because it was passed on to the scheme. Akhil, what's your take and how do you view these proposed changes?
So I agree with Shweta that largely the regulator is keen to ensure that as the industry scales up and reaches newer milestones, there are economies to scale, and and such economies of scale, probably should be passed back to the investors. So cost coming down in any way is always positive for the investors because the leakage of return actually drops down. Now, broadly what we see is there are two large changes from investors' perspective. The larger change, what we see is obviously the cost of trades, where we were paying up to 12 basis point as brokerage. This comes down to 2 basis points. So that's a straight shot 10 basis point benefit back to the investors. So that's a significant, I think, development, point number one. From the AMC perspective, like Shweta mentioned, 5 basis point, which was being charged in lieu of the exit loads, now goes away, right? And they're saying that they've included that in the first 2 slabs. But having said so, the base TERs have come down by 15 basis points. The only flip is that the statutory charges like GST, STT, all of these charges will be now loaded on the total TER and will be then eventually passed on to the investors, right? So, net, I feel that there is a marginal impact on asset management companies and distribution, but a big benefit coming to investors by way of operating costs coming down via reduction of cost on the trades.
Okay. Will this new framework meaningfully reduce the cost gap that we see between active and passive funds? Shweta, let me start with you first on this.
Yes. So, let me talk about a passive fund today. If you're investing in an index fund, most of them have, while they're allowed, I think, 1%, they generally would charge somewhere around 50, 60 odd paisa as the base TER and little add on to that. So even in the passive fund space, there's been a 15 paisa reduction now to that 1%. It's come down to 0.85. So to that extent, it's a 15 bips reduction. But your brokerage and all those costs included, if I look at even the active space now, clearly between the two fund structures, active and passive, in the active side, if you put everything together, the reduction in the TER, the exit loads going away, the brokerage costs coming down could mean somewhere around a 20 bips of reduction across the slabs on the expenses. So would it bridge the gap between the returns that you see? Definitely. The cost reduction would mean that your active fund is seeing little more reduction in your expenses. To that extent, the return differential between a passive and the active fund would go up. The costs would come down between the two. The cost gap would come down, I would say maybe around 10 paisa. And to that extent, the performance of the active funds would further go up.
Okay, and that continues to be the debate always, active versus passive. How do they perform in a market like this? So you are saying the cost would go down and active funds would perform better in that case because of the cost differential that would come by. That's an important clarification. Akhil, the other part of this notice has been that this performance-linked TER framework, which the AMCs can or cannot adopt. The other one is separated execution from research costs. Both of these, will that be a challenge for AMCs, or do you think this is a welcome move?
No, so on the first part, obviously, I think it's a welcome move. Since we also run a large alternate book, and we see that a lot of the high net worth family offices, they prefer to have lower fixed expenses, and a lot of the performance fees needs to be paid once the manager performs. And that kind of a structure, if it can be implemented on the mutual fund structure, so definitely from HNI's perspective, I think it's a welcome move. Now, how and in what format it will happen, obviously it needs to be seen, and we'll wait for a lot more clarity. But if there can be a separate, like in alternates, we have separate share class. Here, if we can have a separate performance plan, and what kind of flexibility is given in terms of hurdle rates, the carry share, etc. But clearly there is an audience in the market who's looking at rewarding the fund managers basis their performance, and will have one more option to choose from between a fixed fees or a variable fees basis the performance. So I think definitely it's a welcome move.
All right, that is some opinion coming in. Let's get you some more. Sandeep Parekh, who's the managing partner of FinSec Law Advisors, spoke to us on the SEBI'S proposal as well. He also expects this to discourage smaller players in the market. Listen into what he had to say.
It does disadvantage new players. It disadvantages smaller players because it will make them either less viable or make them viable over a longer period of time with longer gestation periods. This point is really low, and I think like I said, unless there's evidence that there's either cartelization, that the market doesn't work, and there has to be price cap, I think we should trust capitalism to work. Trust competitive markets to work, and as far as I know, they do work, and I would not kind of support these new price caps.
All right, that's the word coming in from Sandeep Parekh. But with that, it's a wrap on this special edition of Markets Forward. Stay tuned. More news and updates on the other side.